If you are someone living in Canada and looking to invest in the Indian stock market, then in this video, I'll talk about 4 ways in which you can gain exposure to the Indian stock market through Canada. If you're watching this video, then you have decided to invest in the Indian stock market. However, if you're still not sure, then I have created another video where I've talked about 3 reasons to invest in the Indian stock market and 3 risks of investing in India that you should be aware of. The reason to invest in India is that it has been one of the fastest growing economies in the world and will continue to grow in the coming decades due to its young population and improving investment and business environment. And the Indian stock market has delivered a 14% compounded rate of return in rupee terms over the last 40 years. However, currency devaluation and volatility are the risks of investing in the Indian stock market. For more detailed explanation, please check out the video, the link to which I provided in the description below. But for now, let us look at how to invest in the Indian stock market from Canada. My name is Kanak and welcome back to my channel. If you want to learn more about investing, then subscribe to my channel. And your support is what keeps the channel running. So show your support by liking the video and dropping your thoughts in the comment section below. The first and simplest way you can invest in the Indian stock market is by buying ETFs of Indian index such as Nifty 50 through your Canadian brokerage account itself. One of the most popular ETFs is the iShares India Index ETF with ticker symbol XID offered by BlackRock. This ETF is directly listed on the Toronto Stock Exchange and tracks the Nifty 50 index in India, which represents the 50 largest companies listed on the Indian Stock Exchange. By investing in this index, you get a well-diversified portfolio of large-cap stocks in India. Investing 10,000 Canadian dollars in XID in 2010 would have turned into 30,000 Canadian dollars by 2024, which is 8.2% compounded rate of return. Therefore, XID provides an easy and fast way to invest in the most popular Indian index through your existing Canadian brokerage account. However, the biggest drawback of investing in XID is the high expense ratio of slightly more than 1% at the time of recording this video, effectively costing you more than 1% in returns. If you are directly invested in the Nifty 50 index without the expense ratio, then your 10,000 Canadian dollars in 2010 would have turned into 38,000 Canadian dollars by 2024, representing a 10% compounded annual growth rate. Another ETF listed on the Toronto Stock Exchange is the BMO MSCI India ESG Leaders Index ETF with ticker symbol ZID. This ETF tracks MSCI India ESG Leaders Index, aiming to invest in companies with higher ESG scores than their peers. ESG stands for Environmental, Social and Governance, assessing companies based on their sustainability, corporate governance, ethical practices in addition to their financial performance. The performance of ZID has been better than XID, with 10,000 Canadian dollars invested in ZID turning into 32,000 Canadian dollars by 2024. However, similar to XID, the performance of ZID is lower than its index due to an expense ratio of 0.6%. But the good news is ZID has a lower expense ratio compared to XID. However, the past performance does not guarantee future results. So do not assume that ESG index will definitely continue to outperform the Nifty 50 index. But if ESG factors are critical to your investment decisions, then ZID provides you with that option. Now, if you don't want to invest in an ETF, but instead want to directly purchase stocks from the Indian stock market, then the easiest route is to buy ADRs of Indian stocks through your Canadian brokerage account. ADRs, or American Depositary Receipts, are nothing but certificates that represent shares of foreign company traded on the US stock exchange. In simple words, when you buy ADRs, you are not the direct owner of the Indian stock, but instead an intermediate financial institution such as a bank will own the shares on your behalf. Some of the most popular ADRs listed on the US stock exchange are Dr. Reddy Laboratories, HDFC Bank, ICICI Bank, Infosys, Wipro and so on. However, these are only limited number of Indian companies listed on the US stock exchange, and these companies represent less than 100 companies out of more than 5,000 companies listed on the Indian stock exchange, and these are mostly large cap companies. So you don't get an option to invest in mid cap or small cap companies of India. Even though ADRs provide you the ability to directly buy shares, the choices are very limited. The second drawback to buying ADRs through a Canadian brokerage account is the currency exchange charges. When you buy ADRs in the US dollar on US stock exchange, then you will have to convert the currency from Canadian dollars to US dollars. Questrade, Wealthsimple and Interactive Brokers have different exchange rates. So you need to compare and check the best platform that offers you the most competitive exchange rates. Now the third option to access the Indian stock market directly through Canada is by opening an international brokerage account with Interactive Brokers. Through your international Interactive Brokers account, you can purchase all stocks listed on the National Stock Exchange or NSE of India. This is the benefit of opening an international brokerage account, as it removes the limitation and allows you to invest in more than 2,000 stocks listed on the National Stock Exchange. However, at the time of recording this video, only non-resident Indians, meaning Indian citizens living abroad, and foreign financial institutions are able to invest in the Indian stock market through Interactive Brokers. As a non-resident Indian, you need to have a permanent account number or PAN and an Indian bank account to invest in the Indian stock market. For the latest and exact process to open an account, you can visit the Interactive Brokers website and check the guidelines. Now, two costs that you need to be careful of while trading through an international brokerage account are per transaction commissions and the exchange rate for converting your Canadian dollars to Indian rupees. If you're investing in India from Canada, then you should try to avoid short-term trading and instead invest for the long term, for at least 5 to 10 years, as this way you will avoid losing money to commissions and exchange rates. Now, the fourth way to invest in India is applicable only if you are a non-resident Indian. This approach works solely for Indian citizens living abroad. In this approach, you directly open a non-resident ordinary or NRO or non-resident external NRE bank account in India. Once you open the bank account, you link it with the Demat account that will allow you to trade stocks, mutual funds and so on. Most popular companies and banks such as Zerodha, Grow, HDFC Bank and others offer the facility to open both NRO or NRE bank accounts and a linked Demat account. There are many benefits to this approach. Firstly, you gain access to the complete Indian stock market, enabling you to purchase all index funds, mutual funds and stocks listed on both Bombay Stock Exchange and National Stock Exchange. Secondly, you avoid paying high commission fees and high currency conversion rates for every transaction. Thirdly, by purchasing Nifty 50 or other index funds directly from the Indian stock market, you will incur a lower expense ratio compared to buying them from the Canadian Stock Exchange. Expense ratio can significantly eat into your returns over a long period, as we saw in our first example. Therefore, by directly holding an account in India, you get access to more investing options and you can potentially generate more returns by reducing your cost. Now, let me explain the difference between NRO and NRE bank account. From a non-resident Indian's perspective, the most significant benefit of an NRE or non-resident external account is its repatriability. This means that if you decide to stay in Canada at a later stage in your life, you can repatriate all the money from India to Canada. However, with an NRO account, you can only repatriate up to $1 million back to Canada. The second benefit of NRE account is that interest earned is tax-free, whereas in an NRO account, you will have to pay taxes on the interest earned. However, if you have active sources of income in India such as rental income, business income or any other sources, then you can accept those income only in an NRO account. Finally, in an NRO account, you can deposit both foreign currency and Indian currency, whereas in an NRE account, you can only deposit foreign currency. However, when you withdraw from both of these accounts, you can only withdraw in Indian rupees. In summary, if you have future plans to return to India or have existing sources of income in India, then an NRO account would be the right choice. However, if you're only planning to invest in India and then repatriate the money to Canada in the future, then an NRE account would be the right choice. I hope you found this video helpful and show your support by liking the video and hitting the subscribe button.